Good morning, everyone. This is Financial Literacy 101. And today, we're going to be talking about the stock market because I understand that the stock market has been down for quite some time. Pretty much since the year 2022 has kicked off, if you really look at how the stock market is turning out to be, the stock market has been consistently down. Now, some people might want to label this as a soft or small recession or even a market crash, but that's not what it is. This is a down market and it's lasting longer than it usually does. There are certain things that are not directly tied into the financial markets that you may not be paying attention to. That could be one of the causations of the market still being down today. Here's one of the reasons, right? And this is going to continue to have the market being down. And Wall Street extends losses as Russia-Ukraine conflict rattles market. If you notice, anytime in a world where there's conflict, skirmishes, battles, or wars, the stock market uses that as an analytic to decide whether to go up or down. And it's something that we absolutely need to discuss where to put your money for the time being to safeguard it and still make a substantial amount of returns, even in a down market. Regardless of what's going on in the world, battles, Russia, Ukraine, the Middle East, we're still trying to pull out, Afghan refugees coming over and migrants. No matter what's going on in the world, there's still things that you can do with your money, even in a down market. I get plenty of, hey, the market is down this. I've lost $200,000, $300,000, $400,000, $500,000. I've lost $2,000, $3,000 putting my money in these particular shares, and people are trying to find out what to do with it. So a lot of advice I've been giving out is put your money in put options, right? You can always put your money in put options because you already know where the market is going. So those are great places where you can short term make some cash. But what about for the long term? Take, for instance, you have a couple of dollars in Apple, right? Say, for instance, you have, let's say, 10 Apple shares, right? And I forgot how much Apple is per share. Let's just say it's around $300 per share. So you have 10 shares of Apple at $300. And you bought it at 250, but you see Apple is steady declining. And most people like myself would just keep my money in Apple and I would buy more shares. But I know some people are really antsy. They're really anxious about where their money is going. So the next possible step that you can take, which still may yield you returns, green light is on. I'm going to give you some index funds, okay? Not mutual funds. I like to stay with index funds and ETF funds. But when we're talking about long term, especially how this market has been so far, we're looking at index funds. Now, my first advice to you is do not sell any of your shares. If anything, with solid companies like Apple, Microsoft, IBM, Google, Tesla, etc., buy more in a down market. But if you're feeling like you're losing too much too fast and you're being impatient and you don't know the old Warren Buffett slogan that wealth is transferred from the impatient to the patient, then your next possible step is to move your money into index funds. Now, as I show you these index funds, ladies and gentlemen, don't look at the price of the index fund. First and foremost, they're going to be expensive, but with platforms like Robinhood and WeBull and M1 Finance and Stash, long as your investment is over $5, you can invest inside of this and you can make good returns. Also, all of these index funds have dividends, right? Dividends. And I have a lot of my accounts on reinvesting dividends because, again, if I'm investing in the stock market, I want my money to compound. I want my money to comply consistently over the course of time. So these are the things that we need to look at. So let's get into it very quickly here. I'm going to cover these very quickly. Now, despite the S&P 500 ETF for the past year, it's still been up 12.5%. And this was in the fund. You got technology, healthcare, communication services, consumer defense, real estate, basic material, utilities, energy, industrials, consumer cyclical, and financial services. Okay. Also, when we're looking at the returns and how the quarters have been returning, we see that this is 99.60% of stocks and 0.31% of this fund is cash. And you have Apple, Microsoft, Amazon, Tesla, Alphabet, which is also known as Google, Meta Platforms, also known as Facebook, Nvidia, Berkshire Hathaway, and United Healthcare Group. And you see the percentages to the right, and look how much they've been doing well. Okay, moving right along. As we look into the actual return of this particular stock, I believe I have this one out of order. This one goes down here. My apologies, ladies and gentlemen. But nonetheless, Spider is doing very, very well. So I'm going to jump back to Robinhood here. I'm going to do the 5 years. And you see that in 5 years, this stock has been up 83, roughly 84% per share. And again, don't look at the price of the stock, because as long as you're investing over $5, you can invest in this stock. Moving along. Now we're moving on to iShares Core and S&P 500. And we're going to look what's inside the fund. And we looked at the return rate of 12%, or roughly 12.5% over the past 5 years, 41%. And what's in the fund, again, you have technology, real estate, basic materials. They basically have the same thing. Okay. And we'll go over into the holdings. We see what's inside this particular one, which is the ticker is IVV. Apple, Microsoft, Amazon, Tesla, Alphabet, Meta Platforms, Nvidia, Berkshire Hathaway, United Healthcare Group. If you notice, they all have roughly the same shares inside of these index funds, because this is the market heavy in tech. But these are tracking the top 500 listed on the S&P 500. And for you guys who may be vaguely familiar with index, essentially is index is a type of mutual fund or exchange traded fund to track the returns of a market index. The S&P 500 index, like the Russell 2000 index and the Wilshire 5000 total market index, are just few examples of market indexes that funds may seek to track, because a market index measures the performance of a basket of securities, right? And a basket of securities is just a basket of stocks and bonds, which is meant to represent a sector of the stock market of an economy, like whether it be logistics or tech or the agriculture, etc. It just depends on what it may be, and give you a more in-depth definition or explanation of what a stock index could be, or index fund. Market indexes often use a company's market capitalization. If you notice, a lot of times I give you the market cap of a lot of the stocks. And they use this in these index funds to decide how much weight that security, that stock, will have in the index. So the market capitalization, or market cap, is a measure of the total value of the company's shares. The total value is equal to the share price times the number of shares outstanding. So in a market cap weighted index, securities or stocks with a higher market capitalization value account for a greater share of the overall value of the index, because some market indexes, such as the Dow Jones, are price weighted. So in that case, the price per share will determine the weight of the security. Basically, what I've just said is this is how they equate the price of these particular funds. But again, you're looking for some place, some method on how you can retain some of the gains you've made with your individual stocks. And again, this is my second option, not my first option. My first option is for you to keep your shares, and even though your shares are going down, buy more of those shares. And of course, you have options. You have your put options. Then, of course, this option that I'm giving you is simply moving your securities, quote unquote, your stocks, into index funds, okay, which have low expense ratios. Most of them have, especially ones I'm giving you here, have dividends, and they've always shown a positive return over the historical past of the stock market, and even today. So these are really safe bets. I mean, nothing is safe in the stock market, but this is the safest historically to be. Okay. So let's move on. I have two more to cover with you guys here. We went over a couple here, so we're going to cover these. All right. Let's see here. We're going to move over to the performance of the IVV one. And we see here, unfortunately, in the past month and 3 months, it's been down. But if you look from the exception, 7%, if you're looking at under the performance, you see from exception 7%. And this is the usual return of most index funds. Anywhere from 7 to 10% from the exception of them creating this fund, that is the return. And if you notice in the past year, you see 12.5%, the past 3 years, 17.5% roughly. And in the past 5 years, you see around 15%. So these have all been returning very, very well. Moving right along. Next one we have on the list is Vanguard Sp 500 ETF. And you see over the past year, it's been performing at 12.5%. That's pretty good. I have a little bit money here, not much to even gloat about, not even talk about. Now, here are some of the securities that are in this particular fund. You have Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, and Visa. So they have a different mix in the Vanguard. They have some of the same top ones that we read before. But at the end there, you see Procter & Gamble, Johnson & Johnson, and Visa, which is totally different from the other two. Now, when it comes to the performance, ladies and gentlemen, you see from inception, you see around 15%, 5 years, around 15% as well. 3 years, 17.5. The last year, 12.5. But if you notice, all of these are pretty much down for the last month to 3 months, okay? But again, these can get in a very low cost with dividends. Just be aware that all of these have dividends, okay? Moving along, now we're looking at the Spider portfolio S&P 500, and over the past year, they've been up 12.5%. And same sort of sectors that they have with the other index funds. So let's look under the underlying securities. Again, we see Apple, Microsoft, Amazon, Tesla, Alphabet, Meta, Nvidia, Berkshire, and United Healthcare Group. All right. And then when we look at the performance, once again, since inception, you see 10%. As I told you before, you always see 7 to 10%. The only one outperforming here was the Vanguard fund. But then you have 5 and 3 years looking at roughly the 15 to 18%. And of course, in the last year, you're looking at over 12.5%. So these are the places where essentially you guys want to put your money at. And then going back to the SPIG, the SPGI, my apologies, SPGI. This is the prediction over the course of time. Right now, around 470 per share, but it's projecting the next year to go up to 540 at the high and 493 at the medium. So these are some possible ways that you guys can get in and actually secure some of your funds. But my first bit of advice, if you take it or leave, and of course, take all of this information with a grain of salt, okay? This is just some information you guys can use. But don't forget, you can always lose in the stock market. But there's things to do to recoup some of your losses and to actually bank in on the money that's still being traded. So again, first and foremost, if I was you, I wouldn't sell any of my assets, any of my securities, any of my bonds. If anything, I would buy them. I would buy more because they're at a discounted price. Number two, to make money in a down market, you should start looking to put options. Then number three, you can temporarily move some of your assets into index funds to safeguard them just a little bit more while making dividends. But you have to constantly and consistently watch the market, because any uptick, you'll be losing gains of you moving your assets into another fund. Okay. And when I mean assets, I mean once you cash out of those stocks and move those monies into those index and ETF funds. This is Financial Literacy 101. Learn money and be inspired. And if anything, be patient before you do anything with your assets. I'm out.